Hello everyone, welcome to a new video. Today we'll be studying about a very important concept which is called liquidity. Till now we know that a market has two things, one is a POI and a liquidity, and we also know that a market moves from a POI to a liquidity which is called as the bias of the market, and by now you should be an expert in finding the bias of any kind of market. And also under POI, we have learned about blocks, gaps, and also imbalances. But today we'll learn about liquidity. Now, what is liquidity? Liquidity simply means nothing but you can say stop loss hunting of the retail traders. Okay, so this is what liquidity means, or you can say in very simple words, it's a trap. Okay, it's a trap for the retail traders. Now, to understand more, let's take the first kind of liquidity, which is a support and resistance liquidity. Now, support and resistance is one of the earliest concept that was taught in technical analysis, you can say 60, 70 years back. And till now, it's one of the most popular kind of concept that is being taught to new traders who come into the market. Today also, if you just go on YouTube and search support resistance strategies, you will see multiple strategies basically teaching the same stuff. That, let's say, whenever you see a support, market comes down, tests it multiple times, reacts from it, then this becomes a support level. So once again, when market will come, give a reaction, you can take a trade from here and trade this bounce from this support, right? So this is what we are taught. Or if the support breaks, then it turns into a resistance. So once the support will break, market will test this and then market will drop. So either you can directly sell on the breakdown, right, and you can target the next lows, or you can wait for a retest. If you want to be a little bit passive, you can wait for a retest of this breakdown, and then once you see a red candle, a rejection candle, then you can sell and you can put the stop loss just above the rejection candle and you can target the lows. Now this is what we have been taught from the starting to trade support and resistance, right? And the smart money traders means the institutions, the hedge funds, the central banks, they knows this very well, that this is what retails trade. This is how they see the market, because that's what we have been taught. And they take advantage of this thing and they trap the buyers or the sellers, those who trade this support resistance strategy. So what they will do is, let's say we have got a support and market has tested this previously multiple times, and once market comes down to tap this level, gives a reaction from here, we'll be looking to buy, right, and we'll be targeting the highs. What they will do is, they knows that the support resistance traders, they will be buying from this area, they'll put their stop loss below this swing low. They knows this very well. So what they will do is, initially they will give a reaction from this zone, but they're not going to take the market all the way up to our targets. What they will do is, they will give an initial reaction and then they will drop the market, break the support, right? So they have hunted the stop losses of the retail buyers. So first, the buyers have been trapped, right? And once the stop loss have been taken of the buyers, the market breaks the support. Now the sellers come into the picture, because now they're expecting that market could not hold this support anymore. So now the market is going to drop from here. So they are going to look to sell, put their stop loss above the last high, and they'll be targeting the next lows. But what the market will do is, market will take them also out, right? Market is also going to hunt their stop loss. And also there will be, like I told you, a third kind of trader who will look to enter from this area on breakdown and retest, and once they see a red candle over here, they will look for an entry, and market will make sure that market gives a red candle from this area, because they want to trap those sellers as well. But once again, market will initially show a reaction, but market will take them out, and then market will move in a parabolic direction. And this movement will be very, very strong and quick. Why? Because market has taken a huge amount of order of the retails from this zone. Initially, they trapped the buyers, and after that, they have trapped two types of sellers, the aggressive ones and also the passive ones, who will be looking to sell on retest and rejection of this broken level. So this is what a support resistance liquidity looks like. So here you can see that this is the example of a support. Market initially shows a reaction, but then market takes all the buyers out. And once you understand this, you start to look at the chart in a different manner. Even though, let's say you trade support resistance, you do not trade SMC, which I have been teaching you in this course. Let's say you do not trade that, because I know that many of you have been using this concept, support resistance, trend line. I know that because you share your chart, so I know that very clearly. So even if you use them, there is no problem. You can continue using them. There is no issue with that. But make sure that now you wait for this trap to take place, and you enter only after the trap has taken place, only after the swing low has been taken out. Only then you enter the position, not trading the bounce just like everybody else. Okay, so this is what a support looks like, a support trap, and the exact same thing will happen for a resistance. Let's say we have a resistance, market tests this multiple times, shows a reaction. So once again, when market will show reaction, the sellers will come into the picture. Where will be their stop loss? Just above the swing high. And this is very simple to understand. This is not rocket science. If you understand that the stop loss of the retails will be just above the swing high, then it's pretty obvious that the institutions also knows that, and what they will do is they will make sure that they take all of them out, and then market will test this level, the broken level, and again show a reaction from there just to trap more buyers. Because once market will break above this high, then the buyers will come into the market, and they will expect that now the market has broken the resistance, so market is going to go up. So first the sellers will be trapped, and then the buyers will be trapped, right? And then the passive buyers will be trapped, will be waiting for a retest and a reaction, and they'll be entering like this, stop loss just below the low, and they'll be targeting the high, and they will also be taken out, and then the market will drop in a very strong manner. Why? Because the market has hunted all the stop losses that it needed to, and now it has got a huge amount of fill, so now the market will move in a very strong and a quick manner. Okay, so this is what a support resistance liquidity looks like. Now let me take you to the chart and show you some examples. Now this is the chart of gold in the 1 hour time frame. So I have already drawn some examples over here. So this is one of them. Let's see. So we have got a support in the 1 hour time frame, and gold, you can see market initially came down, gave a very strong reaction from here, and once again when market came down, tested this level, you can see there was a reaction. Once again when market came down, tested this level, there was a reaction. So obviously the support resistance traders, they will expect that now this zone has become an established support, and market should not break the zone, and it should push higher from here. So they will wait for market to test this zone once again, and once market tests and they see the strong engulfing candle, you can see over here we've got this strong engulfing candle over here. So once they see this, they'll take their entry. Their stop loss will be below the swing low, and they will be targeting this high over here. Or if they want to be conservative, they're going to target the nearest high, which will be over here. But what happens is, even though there was a reaction initially, after that market drops and takes them out, right? But once market takes them out, does it make it bearish? No. What this is just a trap. But once again, the support resistance traders do not know anything called as trap. What they will do is, once they see a breakdown, a strong candle closing which has broken this support, the aggressive sellers will come into the market. They will sell here, put their stop loss above the candle, or if they want to be conservative, above the last swing high, and they're going to target the next support, which is going to be at this low, right? But you see what happens, they are taken out. Now then the passive sellers will also come into the market, will enter after market retests this level, and they see reaction from here. So they will also come and they will put their stop loss just above this rejection candle, but they will also get taken out. And after that, market will move in a very strong manner. You see the kind of candles that it has created, back-to-back massive green candles. Why? Because it has got huge amount of stop loss orders over here. That's why you see that market moves with strong displacement, big candles, right? Huge candles. So if you trade support resistance, and if you, let's say if you have issues to follow the SMC concepts, in that case, make sure that you wait for a trap to take place before you take your entries. And this is why many people say that whenever I take an entry, initially my stop loss is taken out and then market goes in my direction. Why? Because they do not wait for trap. Why? Because they are never taught that a trap needs to take place before they enter the market. They are just taught that we have got a support, market comes, market reacts, you take an entry from there, and you can expect that market will move from there. But no, market needs liquidity, market needs fuel, right? To move, market needs fuel, and for that market needs orders. So where will the orders come from? The orders will come from hitting the stop loss of the retail traders. Okay, so this is one example of support resistance liquidity. Let me show you some more examples. Okay, so here we have got another one. This was a resistance. You can see market tested this multiple times and market got reacted, right? So once again, when market comes up, test this zone, shows reaction, the sellers will come, they will sell, they will expect that market is unable to break this zone. So it's a very strong resistance zone and market will drop and they will be targeting this low. But you can see that market takes them out, right? So their stop loss gets hunted, and once their stop loss gets hunted and you see a massive green candle, the buyers will come into the market and their stop loss will also get hunted, and then market will move in that direction. So this is what a support resistance liquidity looks like. If I show you some more examples, we have got another one. You can see market reacted from here initially, then again there was a reaction, again there was a reaction from here. So the buyers will come into the market once they see this green candle closing, put their stop loss below the low and target these highs, but unfortunately they will be taken out. And once the buyers are taken out, the sellers will come into the picture. They will sell because we have got a massive candle closing just below this support, breaking the support. So they will sell stop loss above the candle and they will target this low, but they will also get taken out. And we have also got the passive sellers will come after retest and a rejection. So they will sell here, stop loss above the high, targeting the lows, and they will also get taken out. And you can see once they are taken out, just look at the movement. This is the movement that I'm talking about. This is the parabolic movement. And this is what we want to catch in the market. So if you trade support resistance, make sure that from today you follow this, that you wait for market to take all the swing lows out if you're looking to buy, or if you're looking to sell, you wait for market to take out all the swing highs out, and only then you take your entry. Okay, now let's talk about the next kind of liquidity. Now once you have understood this, the next kind of liquidities you'll understand very easily, because it's the same thing. It's just trap and nothing else, just trapping the retails. Second one is trend line. Now trend line is also very popular. As a beginner trader, we are taught about trend lines, right? Let's say we have got a bullish trend over here, right? It's an uptrend. So when market will come down, test this trend line and show some reaction. Let's say we have got a green candle over here. What will happen? The buyers will come into the market and they will take an entry from here, stop loss below the swing low which will be created here, and they'll be targeting this high. But unfortunately, the smart money knows that your stop loss is below this low, and initially they will give a reaction, but after that they will take you out. And once they're taken out, now the trend line has been broken to the downside, right? So what will happen is the sellers will come into the market and they will try to sell it, stop loss above the high, targeting the lows, but unfortunately they will also be taken out because this is just a trap. So this is what a trend line liquidity looks like, and after that market will continue in its direction to the upside. Okay, so this is what a trend line liquidity is. Let me show you some example over here. Okay, so you have got an example here. You can see we had a trend line which has been tested multiple times. First here, there was a good reaction initially. Second here, again good reaction. Third time here, massive reaction. Fourth time here, and again there was a reaction, a strong green candle closing as well. So the buyers will come here, take their entry, stop loss below the low, targeting the highs. But unfortunately, they entered before the trap has taken place. And you can see what the institution does is market takes them out, and then the parabolic movement to the upside. So if you are a trend line trader, and again I know some of you do trade trend lines, in that case wait for the trap to take place. After the trap, you take your entries and you will see market will move in a very strong manner. Okay, so this is a trend line liquidity. Let me show you some more examples. Again here, the same thing, market, you can see tested this trend line again and again, once, twice, so thrice when market comes, reacts from here, and 3 times is when we say that the trend line is valid. Not 2 times, but 3 times. So third time when market reacts from here, gives a strong candle closing, the trend line traders will come, take entry, stop loss below the low, targeting the last high. But unfortunately, they entered before the trap. So they become the trap, their stop loss gets hunted, and then also the sellers will come into the market. Once the market breaks the trend lines, the sellers will enter here, stop loss above the high, targeting the low, but unfortunately, they are also taken out. And like I told you, the passive sellers will also come into the market. They will wait for a retest of the trend line and then a rejection. So here you can see market tested this and also rejected, right? Bringing more sellers, and they will also sell and target these lows, but unfortunately they will also get taken out. So huge amount of stop loss orders have been taken by the market, and then the market will give the strong movement that we want to catch. Okay, so if you are a trend line trader, make sure that you wait for the trap to take place and only then you enter the trade. Here also you can see very similar example with a trend line over here which has been tested 3 times and a bullish reaction. So the traders will enter from here, stop loss below the low, targeting the high, but unfortunately they entered before the trap, and once they're trapped, only then market will push higher. Okay guys, so this is how you can trade trend lines if you want to trade. Here also we can see we have got a valid trend line over here, massive expansion, and then market gives an tap into this trend line and we have got a reaction. So the buyers will enter from here, stop loss below the low, targeting these highs, but unfortunately they're taken out and then market goes in its direction. Okay, so this is what a trend line liquidity looks like. Now let's see the next type of liquidity, which is going to be chart pattern liquidity. Now chart pattern is also something which is as old as time. We have been taught chart patterns, many types of chart patterns, right? We have taught triangles, we have taught head and shoulder, and what not, I mean, yeah, I used to trade chart patterns back in the day, and I actually took pride that I knew so many names of different chart patterns, and stuff like that. But those things are also basically used for trap in today's world. So you cannot use them today. Yes, if you use them 50 years back, surely it would have worked. But today, if you use them, that it's just going to trap you. And let me just show you a quick example of this as well. So we've got a head and shoulder pattern over here. So you can see a head and shoulder basically means that we have got a left shoulder, then a head which is higher high than this left shoulder, and then market comes down, tests this last low over here, which is called a neckline, and then market bounces from here, creates a right shoulder, and then market breaks the neckline. So once it is broken, so this is a reversal pattern, by the way. Chart patterns are basically two types. One is a continuation pattern, another is a reversal pattern. Now this is a reversal pattern. There are some patterns which are continuation pattern, like flag, bull flag, bear flag. So those are continuation patterns. Basically, the market was previously bullish, then market gave a consolidation, and now market breaks to the upside once again, continuing this trend to the upside. So flag, then we have got pennants, all these are continuation pattern, but head and shoulder is a very strong reversal pattern. So basically what we expect is once market breaks the neckline, market should reverse all the way to the downside, right? And that's what many people trade. So you can see what happens is market breaks this neckline over here, and once the neckline is broken, we are taught that we go for a sell. So you can see that the sellers come into the market, they sell, and they expect that the market should drop all the way down. Why? Because this is a head and shoulder, and market has broken the neckline. So now market has become bearish, and now, like I told you, this is a reversal pattern. That means that initially the market was bullish, now it has become bearish, so it is going to reverse all the way down. But you can see what happens is this was just a trap, unfortunately, and that market gives strong expansion to the upside. Okay, and this is just one example. You can use this similar kind of concept in finding out the traps in other chart patterns as well. Okay, now let's understand the next type of liquidity, which is going to be consolidation liquidity. Now this is also a very common and a very, you have to understand first of all what is a consolidation. So basically, let's say that market is bullish. Okay, market is in an uptrend, but market cannot just move like that all the time, right? There will be time periods when market will move in a very strong fashion, and then, like I told you about flag and pole, so basically market will start to consolidate, or you can say it will start to rest a bit. It will just pause for a bit, and then market will once again push higher. But it is not just going to push higher like that, because in order to push higher for the next movement, it needs fuel, and for that what it will do is it is going to trap. So this is consolidation liquidity. Market will consolidate after a strong movement, and then once again the buyers, I mean the support resistance traders, will come into the market. They will see this as a support, right? They will draw some things over here in the lower time frame. They look at this as support, and they will look to enter from here on bounce, and their stop loss as usual goes just below the swing low, right? And they're expecting market to push higher, target this highs, and then market to push higher as well. But unfortunately, they will get taken out initially, and then the market will push higher, right? So this is what a consolidation liquidity looks like. Let me show you some examples in the chart. This is what a consolidation liquidity is. You can see over here, initially market moves up, but then market rests for a bit, consolidating, right? And once again, the support resistance traders, they look at this as, okay, we have got a support, we have got a resistance, but the market is bullish, so we'll be looking to buy. And once market comes down, shows some reaction, they will look to buy, and they're expecting market to break out. But unfortunately, what happens is market comes down, takes them out, and then market pushes higher. And once market breaks this support, then obviously the sellers will come into the market. The sellers will start to sell from here, expecting that the market is going to drop. Why? Because market could not break out to the upside, but it broke to the downside. So the sellers will come, but unfortunately this is just a trap. And then you can see the strong expansion that market gives. So this is what a consolidation liquidity looks like. Let me show you some more examples. Here also you can see we've got the same thing. Market was bullish, but after that, like I told you, market needed some rest. So market just became sideways for a while, and then market breaks to the downside. And once market breaks, the sellers will come, put the stop loss above the highs, and they will be expecting that market is going to drop. Why? Because market cannot break out to the upside and market broke down to the downside. So now the market is going to drop from here, but unfortunately this is just a trap, and then market reverses to the upside, and you can see the expansion that it gave, strong parabolic movement to the upside. So this is what a consolidation liquidity is. In all of them, you can see that market initially traps and then moves in its original direction. If I show you some more example, here also you can see we have got a very clean movement. We have got a bullish market, then market rests for a while, but here also market breaks down and the sellers come into the picture. They sell, putting their stop loss just above the last swing high, expecting that market is going to drop. Unfortunately, this is just a trap. And then just look at this candle over here, massive candle, and then market pushes higher from here. So this is what a consolidation liquidity looks like. Okay, let's look at the next kind of liquidity, which is going to be swing high and swing low. Now we already know about that. Till now we have understood liquidity as swing highs and swing lows, and I already told you that the swing highs and lows, they act as liquidity, right? So we already know about that, but just for an example, I will show you one thing. Here you can see that we have got this as the swing high, right? And then market comes down. We have got a POI over here. Market taps this POI. Then obviously our target is going to be the swing high, which becomes our liquidity, and market goes all the way, takes that out. And once market takes that out, I told you that market can either keep going to the upside, create new POIs, tap them, and then push higher, or market will just take the liquidity and then drop and tap into a nearby POI, and then market will push higher. But here if you look at this price action, then here there is no POI that was created, so market came all the way down. And I told you if there is no POI, then you are going to target at the last low, and you can see market came all the way down and took this liquidity, and from here market gave a reaction. So swing high and swing low are also liquidities, and in charts, whenever we use SMC concepts, we focus on this kind of liquidity, which are the swing highs and the swing lows. Okay, so this is the most popular kind of liquidity that we use, most seen liquidity in the chart. And whenever I do my analysis, I also look at only the swing highs and swing lows as my targets. Okay, now let's talk about the next kind of liquidity, which is going to be low resistance and high resistance liquidity. Now this is very, very important, very important. Once you understand this, then along with bias tells you that okay, you have got a POI and you have got a liquidity. So you know that once market taps here, gives a reaction, market needs to go for this liquidity. But this one, the low resistance and the high resistance liquidity, this tells you that whether this movement will be quick or it will take time. Basically, whether market won't struggle while pushing higher, it is going to push directly, or market can actually show some struggle before pushing higher. Although it has to go and target this liquidity, but the manner in which it reaches there, this is determined by whether we have got high resistance liquidity over here on the left side, or we have got low resistance liquidity. So basically one word you can see over here is resistance. Resistance means the struggle that the price has to face while it is pushing from this POI to the liquidity. So that's the question, whether the market will struggle or not. If it will struggle, then obviously the price action will look something like this. It will spend more time. But if there is a low resistance liquidity, then market won't spend so much time and market will move there quickly. Now let's understand what this means, low resistance and high resistance liquidity. So first let's understand what's a high resistance liquidity. So we have understood in our FVG lecture, if you remember, that when there are multiple FVGs, let's say like this, we've got multiple FVGs. So in that case, the first FVG and the last FVG, they are the most important one, right? We have studied this. So these first and the last FVGs, they can be called as high resistance liquidity. That means when market drops, either the first FVG has a very high chance for market to react and push higher, or the last FVG has a high chance for market to react and push higher. The middle ones, the middle FVGs, let's say we've got one FVG or more FVGs, they have very less chance that market is going to react from them and market is going to push higher. So the middle FVGs that we have, they are called as low resistance liquidity. Okay, they are called as what? They're called as low resistance liquidity. That means that if market comes down, taps into this zone, then market has a chance that market will drop directly through this zone and market is not going to show any reaction from this zone. Okay, let me show you some example over here. So this is the example of high resistance liquidity, by the way. Then we'll talk about the low resistance liquidity. So let me show you some example. We can see over here, we've got some examples marked. Okay, let's see first this one. So we've got back-to-back strong candles creating imbalances, creating fair value gaps, and we can see what happens is we have got this as the first fair value gap, right, and this as the last fair value gap. So you can see what happens is that when market comes down, market taps here, market shows reaction. Market does not break this first fair value gap directly like it did over here, right? Market shows reaction and then market breaks. Yes, market was bullish and market should have gone all the way up to target our swing high, which was our liquidity, but market failed to do so. But it's fine. What we are looking at here is that market has shown respect to the first fair value gap, which is our high resistance liquidity in this case. But we also had this massive imbalances over here, but market did not show any respect to this zone, but market traded through them with massive candles over here, massive red candles. So this is our low resistance liquidity. But once again, when market came and tapped into our final fair value gap, the last fair value gap, once again there was a reaction. And yes, market could not push higher from here, but market did stop here and market did react from the zone before it dropped to the downside. Okay, so this is also high resistance liquidity. So that's why I told you that once you see that we have got high resistance liquidity, then you expect the market to react from this zone, market to struggle here, market to respect this zone, and then market to move. But once you see low resistance liquidity, then you do not expect much resistance from here and you expect that market should move through the zone very smoothly and drop all the way till the next high resistance liquidity comes. Okay, now let me show you some more example. Here again you can see we have got strong upside momentum and we have got multiple POIs over here. We have got initially a tiny fair value gap over here, then we have got the final fair value gap, not final, another fair value gap over here, and the final fair value gap was over here. So you can see that the initial one did not show any reaction this time, but also the middle one did not show any reaction. The final one, that's what gave the reaction, and from here market gave a very strong movement. So this is a high resistance liquidity, and this is a low resistance liquidity. Okay, so I think you have understood what's the high resistance liquidity. Now we'll be Okay, so we do not have any more examples. I was just searching for more, but seems like I don't have any more examples of them. Okay, but it's the same concept you can use in any of them, any of the charts, and it's the same concept, and you can use this in any time frame. I'm showing this you in 1 hour. You can use the same concept in 4 hour and also in the daily, in the weekly, because market is fractal. So market is going to obviously follow the same rules in all of them. Okay, so now let's talk about low resistance liquidity. So let's say that market after a drop, let's say market is bearish, market does something like this. Market starts to consolidate, create a flag or something like that, and then market drops once again to the downside. So this movement over here, this is what a low resistance liquidity is, because here there is a very low chance that there will be any kind of POIs that market will create. So this is a low resistance liquidity, and when market will move through this zone, market will move very, very quickly. And also, most importantly, these zones are created by the retail traders, not by the institutions. So market will consolidate just to create more liquidity to trap more retails, and once the retail has been trapped, then market will move through the zones very, very fast. Okay, let me show you an example. Okay, so look at this. Market was bearish, right? You can see market was dropping, but here what market did was market started to consolidate, and after consolidation you can see the drop. Market did not respect anything over here. We had strong displacement to the downside, taking all of the buyers and the sellers, whoever were here, all of them have been taken out. Now if we look at this price action, then we can see that there is no POI over here. You can see here in this leg there is no POI. Once again in this leg there is no POI. But if we see here, then yes, there was an order block, but it has already been tapped. So till it was tapped, this was a high resistance liquidity. But once it is tapped, this becomes a low resistance liquidity. Very, very important. After that, once again, we had another order block which was tapped, and you can see there was a reaction. So whenever it is tapped for the first time, this is a high resistance liquidity, and market will show reaction from there. Here again, we had another order block, market tapped, and once again there was a reaction. But you can see once all of them were tapped, there was no POI that was left untapped over here, and that's why you see this massive reaction to the downside, massive back-to-back candles, no reaction from these zones over here, right? So this is what a low resistance liquidity is. Yes, and a high resistance liquidity can also turn into a low resistance liquidity if the high resistance liquidity, that means the POIs, whether it's blocks, gaps, imbalances, whatever they are, if they have already been tapped, then that turns into a low resistance liquidity. Okay, here also you can see that initially market tapped this zone. We had this single order block over here in this movement, in this price action, but once it was taken out, apart from that, there was no POI. Yes, there was a POI over here, but this was not reacted from, and market dropped in a very strong manner all the way down. Market did not bother whatever was here. So this is a low resistance liquidity. Okay, very important concept, guys. Here also we can see that market dropped all the way down. Market was bearish. You can see we had this breakout structure, so market was bearish. And here again we had multiple POIs. Initially we had this one, then we had this one, but market did not react from any of them. Market went all the way up and targeted this last POI, which is going to be this last fair value gap, and from here market then dropped all the way down and market took out this low, right? So this is what a high resistance and a low resistance liquidity is. Very, very important to understand whether market can actually give a strong move or market is going to struggle before market targets that liquidity, which is going to be our target. Okay, so these are the most important kinds of liquidities that we see in the market. Okay, so that's all about liquidity. In the next class we will be studying about entry models. I'll give you some entry models, although we have talked about entry models before, but I'll give you some entry models and I'll also show you examples in the chart. And yeah, we will see how to take entries based upon our analysis and our trade setups, our bias. Based upon that, how can we take entries? Okay, so that will be the last class of this course, which is going to complete this course. And if you have any queries in this course till now, then you can let me know and I will try to help you out with that as well. And also, if you want live doubt sessions, in that case you can let me know in my Telegram handle, which obviously you know. And yeah, we will plan with that, and we will yeah, we will solve whatever doubts you'll have. And yeah, we will see about that. Okay, so this is all for today. I'll see you in the next class. Till then, keep practicing this. Once you understand liquidity, whatever strategy you use, whatever it is, I mean, if it's even simple trend line, if it's simple support resistance, you look at the chart in a different way. You wait for the trap to take place, and only then you take your entries. Okay, so that's it for today. We'll see you in the next class. Till then, keep practicing, and if you have any questions, if you have any doubts, let me know.